Larry, this week, Fed Chair Jay Powell did what he said he'd do. He said, we're going to taper a lot faster. We're going to get to the possibility of rates sooner. Did he do enough?
I suspect in the end it won't have been enough. You know, what they're planning is 3.5% unemployment for 3 years with steadily decelerating inflation without the interest rate ever getting as high as what they think the neutral rate is. That could lead to sharply declining inflation, but it wouldn't be my expectation that that's what's going to happen. On the other hand, there's a case for making adjustments gradually, and it may be that this is the first stage in what will be several adjustments, and it needs to be recognized that the market doesn't even expect them to hike as much as they're saying that they're going to hike. So it's a complicated situation. I was glad to see the movement in the direction that they moved. But I think if you look under the surface, they're still kind of betting that inflation is heavily transitory because they're not really applying restraint to the economy of a magnitude that would be expected to diminish inflation in a very substantial way.
Well, let's talk about the transitory, because we've talked to a couple of economists this week. Austin Goolsbee used to be White House economist. Cecilia Rice, whom you know well, current White House economist, who don't use the word transitory, but they say something close to that, saying, look, whether this affects inflation or not depends on the causes of it. And if the cause is really some supply chain problems, those are going to go away on their own. And therefore, we didn't need to do as much on monetary policy. What do you say to that?
Cece's a former student of mine and someone I respect greatly, but I don't see it quite the way she sees it. Here's what I see. I see shelter is 1/3 of the CPI. I see house prices going up 20%. I see every private sector rental index up in double digits. And I see the CPI calculated with long lags and only up 3 or 4%. So that says to me that we've got another 8 to 10% of shelter inflation coming in, weighted by 1/3. That's almost 3% right there in terms of a contribution to inflation. I see a red-hot labor market with labor shortages, with hourly wage rates accelerating, and ultimately, labor's the most important source of costs. And all the businesses I talk to and all the businesses where I read reports from stock analysts say they've got a lot of pricing power. So if you take housing and you take labor, and then you add to it, David, that the consensus forecast is for the economy, the Fed said, to grow something like 4% during 2022, and you take an economy that's growing 4%, with almost no productivity growth and a labor shortage, I think you're going to see new bottlenecks emerge, even as old bottlenecks are fading away. So it might turn out to be the case that they're right, but I don't think we can plan on it. And I am concerned that we've hidden the word transitory, but we haven't hidden the concept that inflation is going to solve itself. And I think that idea was wrong, and that's why I was encouraged when Secretary Yellen and Chairman Powell said they weren't going to use the word transitory anymore. But I think that idea is still very present, and my fear is that it's a problematic one, and my fear is that it's an idea that's going to do damage to policymakers' credibility. But no one knows, and this might work itself out in a reasonable way. Certainly, OMICRON is a big wild card that could change everything. Whether it's going to do more to reduce demand than it does to reduce supply, in which case it would slow inflation, or whether it's going to do more to reduce supply than it does demand, in which case it would tend to increase inflation, I think that's very hard to judge at this point.